I give all of the viewers of this show a steady and regular diet about, trading and what works with trading and mostly what doesn't work with trading. But just to explain who you are, give us a background to Global Trader, the business niche you're in and what you've done over the decade or so you've been in business.
We started off as a very niche derivatives player, focusing on bringing two new products to the South African market, which were CFDs and spread trading.
Right.
That was back in 2000. On the back of that success, we launched a global business. And over the last 10 years, or predominantly over the last 3 years, we've diversified into being a full-service stockbroker. So we offer everything from DIY trading on the very left-hand side, all the way through to asset management on the very right, and in the and in the very middle, we've got something that we call assisted trading, which has a whole lot of tools geared at helping people make their first trade. And the best analogy I've got for you is if you've ever played in a casino and you played blackjack. In general, the first time you play your hand, you play by standing behind someone. So we provide services where you can stand behind real-world players, and then when you're comfortable and you're educated enough, take a seat at the table. Okay,
before we go into the nature of how that service might work, just go back a step. So in other words, we're not talking necessarily here about straightforward buying and holding common equities. You're talking about derivative trading, contracts for difference, where you're using, in effect, borrowed money to increase your exposure to whatever it is you're doing. You can go both long and short.
Yeah.
So just explain for those viewers that are not familiar with this, how the basics of that works and who's the counterparty and so on.
Sure. I mean, the best way to describe CFDs is to use something that everyone's familiar with, and that's sort of mortgages for purchasing a home.
Right.
And CFDs are essentially identical to providing a mortgage, but in this case, you're not financing homes, you're financing financial assets. And the key difference is that obviously the volatility of those assets is much higher, and so the mark-to-market needs to happen daily as opposed to every time you visit your bank 3 or 4 years.
Right.
So in essence, what we do is we provide financing for clients to go long or short to the equity markets, and we supply multi-asset coverage, so indices, currencies, commodities. We also give them access to both international and local markets. And I guess the key differentiator between us and other forms of trading is the ability to go long and short. And in our view, if you've got to maximize opportunity in markets, you need to be able to make money when the markets are going down, like today, and when they're going up.
Okay, so just give me that spread of assets again. So it's mostly liquid equities in the South African market, but also global markets.
Yep.
If you have a view on where Microsoft is going or where Apple is going. It's currencies as well, which means the major crosses. And then what are the others? Commodities.
Commodities.
So you could have a view on where oil's going, copper, and so on and so forth.
Exactly. I mean, a concentration of our risk or trading volume comes from two key areas. The one is the international indices, Dow Jones, S&P, the local Aussie is a big constituent of our flow. And then commodity interests, gold, Brent, silver, more recently silver's become a very hot topic. And so really wherever the volatility is happening, our clients have got a destination to trade.
Okay, and who provides the gearing? In other words, if you've got 100,000 Rand, you fund an account, who provides the gearing so that you can take a 500,000 Rand position? That's the first thing. And secondly, if you've got all these clients doing these things, within your business, I assume you then pay careful attention to who in aggregate has taken what exposure so you can offlay that risk so you don't carry it yourselves.
100%. At the center of our business sits a highly sophisticated risk management system. And what we do is we aggregate all our client risk. And in global markets, they call us a retail aggregator. And then we will offset that risk with institutions, prime brokers, banks, and the like, and even the exchanges. So we might offset our gold risk on SAFEX or silver risk on SAFEX. And essentially the financing comes from us, but we get the same lending terms from the banks or prime brokers that we give our clients. So we're not actually leveraging our own balance sheet. We're leveraging the wholesale capital markets and providing retail access to it, which the man in the street has never been able to get before.
Okay, but that's a good point. In other words, your counterparty, your client has you as a counterparty, and I think that is important. So if someone's a customer of yours, they're going to be checking you out, because we know that there have been other players in the sort of CFD market that basically blew up, partly because of their clients' misbehaviors, but partly also because of relatively insufficient risk management systems themselves.
Sure. I mean, at the center of this business is risk management. And the counterparty assessment and due diligence that a client needs to go through when dealing with an over-the-counter broker like ourselves is much higher than the due diligence they need to go through if they're trading on exchange. And so that's a very important differentiator and something that the client needs to take, takes responsibility for. And he needs to look look at the financials of the company, most importantly, understand their risk management policy, and then look at their track record.
Okay, just talk again then about that DIY assisted and other sorts of trading activity. When you talk about DIY, that's somebody who literally comes in and takes their own chances. They can be a member of a community or something. How exactly does that work, and how does that assistance get provided?
Well, from a DIY perspective, opening an account is a very simple process. I mean, literally you can be up and trading in a couple of minutes rather than days or hours. We don't provide credit, so you have to fund your account. The longest piece to get trading is actually getting money into your account. If you're going to make your decisions for yourself, then there's no further support that we need to provide you other than give you the platforms to trade the instruments that are available.
And presumably to provide sort of stop-loss type stuff, so that if somebody's losing, they don't get carried down.
Yeah, we insist that every transaction has a stop-loss associated with it. We try and encourage the clients to put a take-profit in, but we can't force them to do that. But we do force them to take stop-losses, which means that their downside risk is protected.
Well, it's protected to the base capital they put in. In other words, the worst that can ever happen is that you wipe out the funds that you bring along.
Well, not necessarily. If let's take a simple example. If I trade the Wall Street and I've got 10,000 Rand of capital and I put 1,000 Rand behind the Wall Street, and let's say I just buy the Wall Street for argument's sake. If I place a stop loss 100 points away from the market, you have the facility to guarantee that stop. It costs you a few extra points in the process, 2 extra points. And if you take that guaranteed stop, then you are guaranteed that you cannot lose more than the capital that you placed on that specific trade.
That makes sense.
And so from that perspective, the clients, when they're trading in highly liquid instruments, we will provide them with guaranteed stop losses. And where the volatility in those markets dictate. Also where the markets trade 24 hours a day. So as an example, if you were looking for a guaranteed stop on the ALSI, we wouldn't provide it. And the only simple reason isn't because it's illiquid or too volatile, it's that there's a gap risk because of the overnight movement in the ALSI. I don't think it's going to be long before we see a 24-hour market in the ALSI, and when we do, we'll happily support it with a guaranteed stop loss.
Okay.
And those are the kinds of services that I think the retail investor really needs, so that they can't lose more than they've got.
Okay, and tell me briefly, what's this thing called the wire? It sounds a bit like StockTwits in the US.
Yes, it's exactly like that. Social investment or social trading, which comes off the back of Twitter and Facebook and all of the sort of hot topics in social media today, I think is going to play a massive role in the future of financial markets. And the reason is that it provides an opportunity for clients to stand behind other players, see their success, so see exactly what positions they're taking, assess them in terms of their risk profile, and follow them when they want to and when they don't want to.
And look for people that have a similar approach that they can kind of bounce off and so on and so forth.
Yeah.
Okay, my key question about the trader community is that people think it's an easy thing to do. You know, they read about people making money on the stock market. They do a little bit of very basic stock research. They have a family member who's interested in stocks. And they think that if they take their small grub stake into the market, that they can, you know, get a system going and make money easily. I mean, I'm critical of that because for me, my own experience has been that very few people make money sustainably calling the zigging and zagging of the market. What's your observation about that?
It's like any profession, Paul. You know, the top 10 to 20% will do well from financial trading. But to do well is a dedicated effort. You know, my analogy is in golf, there are hundreds of thousands of players, millions of players that play golf, very few that make it into the big league. And so it's the same with financial trading. If you think you're going to go in there and make a quick buck, but not put the research and effort behind educating yourself, then invariably you'll lose money. But if you prepare to put the effort in, then the returns can be very handsome. But again, it's an 80-20 rule. 20% of individuals that get into trading and dedicate and put some effort behind it do really well. It's not dissimilar to any industry. I mean, whether you're a CEO of a corporate company or whether you're a first-time investor, really the differentiator is how much effort you prepare to put behind it. It's not something that you're pre-qualified by because of your experience or necessarily because of your education.
Yeah. Good. We've run out of time, believe it or not, but I understand one quickie before you go. I follow you on Twitter and I know you've got a horse in the Durban July. I mean, that is incredible. What's its name so that I can work out how to pick that one in the office pool?
His name's Captain's Wild. He's currently trading at 66-1, and yes, he's in the July, which is everyone's dream to own a horse that runs in the July. We've got 40 people going down on the train to watch him run, all dressed in pink and black, and we're hoping for big things from him. And if you've got extra Rand lying around, you'd do worse by putting 100 Rand behind him.